there, welcome to Commodities. I'm Lindsay Biscaya. Let's take a look at how some of the key commodities are trading today. We'll begin with energy prices, starting with the price of oil. Prices have been slipping as investors are digesting some fresh developments in the U.S. and Iran tensions there. Those talks are ongoing. You can see the price of oil is down almost 3% at the moment. If we take a look at the price of gasoline for today, believe it's also trending down as well. Yeah, down more than 3% at the moment. Natural gas as well. Prices with natural gas have been flip-flopping today, rising after a report shows inventory in the U.S. fell last week, and currently the price of natural gas up by almost 2%. If we take a look at where some of the metals are trading today, gold is tumbling in a shock sell-off across the financial markets. We'll, of course, be following this. This just started happening this afternoon. Gold down almost 3% at the moment. Silver also plunging as much as 10% at one point today, now down just over 9%. And if we take a look at copper as well, down 3%. So again, we will continue to follow this story of the precious metals and that shock sell-off. In the meantime, though, here's some of the stories we're watching today. Shares of Birchcliffe Energy are seeing a decline. That's after the company logged lower profit in its latest quarter. On the upside, Birchcliffe posted revenue that came in above consensus, driven by higher production and better prices, and saw production jump 7%. West Fraser Timber shares are slipping, meanwhile, after sales for its fourth quarter missed estimates. West Fraser also posted a loss of $751 million US. CEO Sean McLaren says the company faced a challenging quarter amid elevated duties and tariffs on softwood lumber. Last month, the company said it would record a goodwill impairment charge in its lumber segment. And shares of Precision Drilling are sharply lower today as well, down almost 9% at the moment. The Calgary-based oil and gas driller reported a loss in its latest quarter, as well as revenue that came in below expectations. Precision says the quarter was also impacted by a $67 million charge related to the decommissioning of 31 of its drilling rigs. The company says those assets were no longer aligned with its advanced technology and performance standards. And oil prices, as we mentioned, are declining today as traders evaluate ongoing peace talks between Tehran and Washington and consider improved supply conditions after a recent winter storm disrupted some U.S. production. Let's welcome in Pavel Molchanov, Senior Investment Strategist at Raymond James and Associates, for some analysis on this. It's good to have you join us. Thanks so much.
For having me.
So when it comes just overall to recent earnings report for some of the big oil and gas producers, is there any big takeaway that you see so far or any trends you're seeing?
Capital discipline is a big theme in the industry. If we look at the 5 Western oil and gas super majors, the big oils essentially, their CapEx is going to be down 5% in 2026 to the lowest level since 22, when there was still a lot of COVID impact in the oil industry. And in fact, it's even down versus 10 years ago. Consider all the inflation we've had in the last 10 years, and yet these companies are spending less on drilling now than they did all the way back in 2016. That tells us that they just do not see a lot of reason to be drilling new projects. Instead, they are returning more money to shareholders via dividends and buyback.
It's interesting you mentioned that because unlike its counterparts, British Petroleum is suspending its dividend purchases to strengthen its balance sheet. What's the right way to go here? Is there a correct strategy, do you think?
Well, certainly investors, prefer, as much dividends and buyback as possible. Now, some companies, as you noted, need to be, more careful with their leverage metrics. So, they can use buyback as a flex variable. Let's keep in mind, oil prices, even though they are up a little bit year to date, are a lot closer to their, 5-year lows than their 5-year highs. So, back in 2022, after Russia invaded Ukraine, we had oil prices close to $100 a barrel for a period of time. Obviously, we're nowhere near that today. So companies are needing to curtail their capex. They're still paying their dividends. And if oil prices were to bounce, we could see more buyback. If oil prices kind of languish where they are, we could see some pulling back on their repurchases.
We were just looking at WTI. It's slightly above $60 a barrel. I'm wondering, you kind of touched on this off the top, so I think I know your answer, but will oil producers increase their production in the coming months to try to capitalize on some of these prices, do you think?
Short answer is no. I mean, certainly there are some oil field projects that are scheduled to come online in 2026. In places like Brazil and Guyana, Norway. But remember, these are long lead time projects that were in the works for anywhere from, 3, 4, 5 years. When a lot of our listeners think about oil supply, they think about shale, which do not have 5-year timetables. These are more, kind of short-term drilling decisions. And as it stands, the rig count in the United States is close to its post-COVID lows. Even though, again, we've seen a little bit of a bounce in oil, it's just not enough to get companies excited about drilling.
Your price target for WTI, correct me if I'm wrong, is around $55 to $60 a barrel. I'm wondering what that tells you about the landscape of oil right now and kind of the risks that we could see throughout the rest of this year.
Yeah, we think prices will actually kind of pull back lower over the next 6 to 12 months. Because, frankly, we have continue to have an oversupplied global oil market. Last year, if we just think about those long lead time oil fields, in places like the deep water, we had close to 2.5 million barrels of new supply coming on stream, as compared to growth in global demand of only 700,000 barrels, so 3 times more of a supply increase. And that's not even including, what's happening with OPEC's production curtailments. Mm-hmm. This year, we're looking for another 2 million barrels a day of new oil field startups. Again, this is not shale. These are the long lead time oil fields. And let's assume global demand is up another 700,000 barrels. So yet again, a lot more incremental supply than what the oil market needs based on the very modest increase in demand.
Let's switch gears a little bit here and take a look at China, because Energy Secretary Chris Wright was saying that China bought some Venezuelan oil from the U.S. recently. I'm wondering, do you expect that to continue in terms of China buying this oil?
So it ultimately does not matter which countries, point A or point B, you can ship oil anywhere you want. It's, very fungible, as opposed to natural gas, where logistics work in a more complicated way. So it doesn't really matter whether China buys more from Venezuela or Saudi Arabia or Iran. Ultimately, it all kind of levels out. The important thing about China is that last year, 54% of Chinese auto sales were electric. That is by far the highest of any major economy, an astonishingly high number. Those percentages will only go up from here. And so China, as an oil importer, is becoming not as significant, certainly as a growth driver for oil demand, not as significant as it was 10 or 20 years ago, because of its astonishingly high electric vehicle adoption curve. If we had half of U.S. auto sales going electric, the U.S. would be a lot less impactful as a source of oil demand. But in China, it's 54% and growing. And that means there's just not going to be as much room for China's oil demand to grow going forward.
Going to be interesting to see what happens. Okay, that's all the time we have, but appreciate you joining us today. Thanks so much.
Thank you.
That was Pavel Molchanov, Senior Investment Strategist at Raymond James and Associates. Up next, gold and silver prices pulled back today, and we'll bring you the latest on what's driving the recent volatility in precious metals. That's when we come back. Stay with us. Birchcliffe Energy's latest quarter looked weaker on paper, with profit down even as revenue and cash flow jumped on higher production and better prices. And for more, we were joined earlier by Chris Carlson, President and CEO of Birchcliffe Energy.
From Birchcliffe's point of view, we had an excellent fourth quarter and actually full year 2025. So if you look at the production on the full year, we averaged over 80,000 barrels a day for the year in 2025, which is a record for Birchcliffe. So a milestone there. And then production in the fourth quarter was really strong as well, sitting at 83,000 BOEs a day. So production's really strong, and that's really on the back of efficient execution throughout the year and also driving our costs lower. So our business and our people have been really focused on those two initiatives, looking for efficiencies throughout the business to drive our capital costs down as well as our operating costs. So you saw both fall in the year of 2025. We were able to drop our per well costs by just over 10% year over year, as well as our operating costs are down to a record low $2.88, which is down 10% as well from 2024. So overall, really happy with the performance. In addition to that, I would just add we had really strong cash flow for 2025 and in the fourth quarter, which allowed us to pay down debt. We paid down almost 14% of our debt position from where we were at the end of 2024 versus today. So company's in a really strong position as we move towards 2026.
Yeah, there's some really strong numbers in this latest report, but I did want to ask about the lower profits that were reported too. What happened there? What are you attributing that to?
Yeah, so in the profit line and the net income, it's usually unrealized future gains or losses of a position we have out at NYMEX, sorry. So that can swing from quarter to quarter. It's just a mark to market based on where the forward prices are going. And as you know, that's changing quite volatile. So overall, where we're focused is the adjusted funds flow, which is how much cash flow the business is creating. And we generated about $422 million of cash flow in 2025 against spending of right around $300 million. So we probably had $117 million of free cash flow, which we were able to pay that sustainable dividend of 12 cents annually, $33 million a year, as well as reduce our debt and strengthen that balance sheet. So overall, again, like we talked about, the numbers look really strong from our point of view.
Yeah, and as you mentioned, like the prices for oil and natural gas have been absolutely swinging. Natural gas prices going higher for most of the winter because we've been having such a cold winter. So I wonder how much of what you're seeing in the numbers you can attribute to that, just that we've had such a cold winter and so natural gas prices have been going up.
Yeah, and certainly we've seen some cold weather out east. I know specifically the luxury of Birchcliffe, one of the differentiating factors for us, we would have in 2025, we had about 72% of our gas sold outside of local AECO markets here. So we were able to get 40% of our gas that's long-term committed out to Dawn, which is in Southern Ontario, sold in U.S. prices. We also had about 35% of our gas in 25 sold at NYMEX, which was also a strong market. So when you look then into 2026, the cold weather, which really started to amplify here in late January into early February, and I know you guys have seen it specifically in eastern part of the country, it's really cold out there, and we've had the luxury then of having almost 40% of our gas sold out into that market early here in 2026, and that will continue on for a duration. If you just take a step back and think about the local market at AECO, which has been relatively weak, and our weather out west here has actually been quite unseasonably warm. So, you know, when you think about the local AECO market, which we sell in 2026 about 45% of our gas into this market, that LNG facility on the West Coast is just continuing to ramp up over time and finish the commissioning phase. So we'll start to see the benefit of that here into the spring, summer, which will cause, again, more demand pull out west here, specifically at this AECO market. So I think the most important part is you need to be diversified in your gas sales points, and Birchcliffe certainly has the luxury of that.
Looking ahead, Birchcliffe also, you're aggressively developing a new high-quality land position in the Elmwood area of Alberta. I believe you're aggressively trying to develop that. I'm wondering, what specific milestones or conditions would give management the confidence to approve a positive FID there?
Yeah, so our first priority here in 2026 is to fill the existing infrastructure we have, which is in our core Pouce-Coupé-Gordondale area. And so we'll grow the business in 2026 by 5 to 6%. And if you went from Q4 25 to Q4 26, which is when we plan on having that infrastructure full, we'll grow probably almost somewhere around 8 to 10%. So significant growth coming, and I'd say low risk growth and very profitable growth coming by filling our existing infrastructure in that core Pouce-Gordondale area. And then as you mentioned, Lindsay, is that we've got a future development area in Elmworth, and that really is a 2026 end of year, early 2027 decision point on us potentially building a 100 million a day gas plant down there and drilling the associated wells to fill it. But I think our business and our company and our people are really excited about that future development asset in the context of it's a fresh map sheet down there. We've only drilled 3 wells on almost 150 square miles of mineral rights that we control. So the reality there is we can take all the learnings from our Pouce-Coupé-Gordondale asset and all of our strong team members that we have in Calgary and up in the field and really exploit it down there and create value for our shareholders.
That was Chris Carlson, President and CEO of Birchcliffe Energy. Well, up next, gold and silver prices pulled back today, and we'll bring you the latest on what's driving that recent volatility in precious metals. That's next. Stay with us. The price of gold is dropping in a sudden sell-off today, with some traders dumping metals to cover losses in equities, while silver and copper also took a hit. So for more, let's bring in Bart Mellick, Managing Director and Global Head of Commodities Strategy at TD Securities. It's good to have you joining us. Thank you.
Well, great to be here.
So given what we're seeing just this afternoon, I'm wondering, the volatility we've seen so far this year when it comes to the precious metals, you expecting that to continue probably for most of this year?
I think, unfortunately, volatility will be a fact of life here for the foreseeable future. And of course, the issue is very broad. One big issue is, of course, we're not quite sure what U.S. data will come out as. The other day, we've had employment numbers that were stronger than expected today in inflation. And at the same time, we're seeing the Chinese nation basically going off for their New Year celebrations. And that means maybe less liquidity in this market. And we're not quite sure whether there is a lot of appetite for the so-called debasement trade for now. We've had gold, go to record highs along with silver. There have been significant corrections. We've been back again. And now, well, we're not sure if interest rates are going to go down. We're not sure if there's going to be continued appetite from Asia for these precious metals as a hedge.
You're also projecting gold will average about $5,000 an ounce in the first half of 2026. Like you just mentioned, a whole number of factors here that's influencing gold. Is there one in particular that is making you think gold's going to just average around 5,000 for a while, or is it everything combined?
Well, I do think that 5,000, our quarterly average for next quarter, in fact, is still a pretty robust price by historical standards. What I think will get us there is the fact that after Mr. Powell leaves office, we are going to get a Fed chair who's going to be a little bit more predisposed to lowering rates, particularly on the short end of the curve. But the reason we don't have it shooting massively higher, like many some in the market have, is because we're not all that sure that he is ready to sacrifice inflation or allow higher inflation at the altar of incremental marginal growth in employment and the economy. So I think there's a lot of uncertainty. once we have the new chair in place in May, we'll see what he thinks is appropriate for the market. But at this point, not so sure that we're going to see anything happen on the monetary front. And as far as retail demand, I think at this point you might see some profit taking. There wasn't a lot of enthusiasm for speculative traders at this point. So I think this market is trying to consolidate its recent gains.
Let's turn to silver now, because you mentioned recent volatility in silver was driven by a gamma squeeze. Can you explain what that is?
Well, that's something that I think has ended for now. But what we've seen is we've seen a lot of enthusiasm, particularly on the retail side for silver. And we fundamentally like silver a lot. This is a market that's going to stay in a deficit for quite a long time. But what we've seen not that long ago, is retail investors going very, very aggressively into the options market and buying call options on publicly traded funds. And the result of that is that market makers, folks that issue a lot of those funds, had to stay so-called, delta neutral. They didn't necessarily want to take directional risk, and they went into the market that was already fraught with illiquidity and inventory issues, and had to buy physical to hedge against that risk. So they were short on the option side, so they went long physical to balance things up, and that I think caused a squeeze. Got very aggressive 2x, 3x leveraged funds in there, and then we had some bad news as far as the market was on the precious concern. Is President Trump told us that he's looking at Kevin Warsh as the new Fed chair, who, as I said, is more of a hawk on the inflation side, and it's not all that clear that he will put metal to the pedal on interest rates.
Just in our last minute here before we have to wrap up, I'm wondering, we could get some clarity on tariffs later this year, in the summer, maybe. How would that affect the price of copper, of silver, of gold? Do you think that would affect, how would that affect it?
Well, certainly that is something that we're all talking about in the metals trading community. And if we get some sort of resolution in June, when these tariffs are maybe postponed for another time, where it's decided that it's not accretive for the United States, I think a lot of the inventory builds we've seen in the U.S. for a lot of these critical metals, copper being one of them that has seen a lot of inventories, silver another one, could reverse course, and we could have loosening up of the market in quite a material way. So reversing a lot of those constraints that have propelled it to record levels.
Okay, that's all the time we have. Bart Melek, appreciate you joining us today. Thanks so much for your insight.
It was my pleasure. Thank you.
Thank you. And thank you for watching Commodities. You can email your story ideas to commodities@bnnbloomberg.ca.